Hello, good afternoon, and welcome to today's episode of Modesty's Property Corner. How are you all doing? I hope everyone is well. Well, it's Wednesday again. We're halfway through this working week. Looking forward to the end of the week, looking forward to the weekends. But before we get there, we've got to do what we've got to do. And what have we got to do today at Modesty's Property Corner? This is season 1, episode number 10. I remain your man, E10 Umezudike. And today we are still continuing from where we stopped last week. We are still talking about mortgages for the credit impaired. For people with poor credit, for people with less than perfect credits who are looking to get a mortgage. We started last week by describing the different kinds of situations that could get you into a poor credit situation. Things like CCJs, things like IVAs, things like debt management plan, missed payments, defaults, and everything else you can think of that negatively affects your credit status. So we identified those things last week, and then we started talking about different questions that lenders do ask when there is less than perfect credits in front of them. When there's an application to a lender for a mortgage and the applicant has less than perfect credit, there are certain questions that the lenders do ask before they decide whether it fits their criteria or not. We discussed some of those questions last week, and we're going to continue discussing those questions today. The reason the lenders ask these questions is because they want to be sure, and they want to, kind of protect their interest in the property, because when a lender lends you money, they have a stake in the property, and they want to be sure that what is happening or what they can see is just historical. The history might not favor you, but they want to be certain that going forward, you will not find yourself in similar situation again, which will hamper your ability to be able to pay your mortgage. Remember that every lender is mandated by the Financial Conduct Authority, the FCA, to be a responsible lender. And being a responsible lender means you are not expected to lend someone money when you know they cannot afford to keep up with payments. Because taking a mortgage is a hefty financial commitment. And if you lay more financial commitments on top of someone who is already financially burdened, you are not a responsible lender. But the lenders also want to be sure that your credit history does not really stop you from, achieving your ambition of buying a home. They do not want to see your history hamper your future, which is why they are looking at, okay, you've got this poor credit history, but from what we can see, henceforth going forward, we think you are in a position, in a good position to be able to afford the mortgage, and that the mortgage is affordable. The key word there is affordability. Lenders do not joke with affordability. They want to make sure that whatever money they are lending to you to buy that property is affordable. It's not going to be a financial burden for you going forward. Okay, so that's why they ask questions like, okay, how old is this credit impairment record? If you've got a CCJ, how old is it? When was this CCJ recorded? This default on your credit account, when was it recorded? This missed payments, when did that happen? Or this debt management plan, when was it registered against you? Or bankruptcy, okay, you made bankrupt. How long ago was that? When were you discharged from your bankruptcy? Lenders want to know how far back these things have happened. Now, different lenders have different criteria for tolerating poor credit history. For some lenders, as long as that impairment is 6 months or older, they have a product that can take care of that. For some lenders, it is 12 months. If it's 12 months or older, they have a product that can take care of it. Well, for some lenders, it is 3 years, minimum of 3 years, or for some it is 24. So what we're saying is from 6 months up to 6 years older, there are certain credit impairments that lenders have designed a product that will fit that criteria. product that will fit that personality, a product that will fit that applicant. So it's all about the design of the lender's product. And remember, for people with credit impairments, I said it last week that it is no longer just a case of specialist lenders who charge exorbitant rates that now have some level of flexibility and tolerance for, people with poor credit or poor credit status. Some high street lenders are becoming flexible now with, credit impairments. Some high street lenders can tolerate, applicants who have, CCJs that are 3 years old or older. So if it's 3 years or older, they can tolerate. I've got, a few lenders who are high street lenders who can tolerate that. So they're becoming a little bit more flexible as long as it's old enough for them to be convinced that yes, this is an old record, but for the past 3 years, this person has kept himself or herself clean, credit wise. No more CCJs, no more. And they will make sure that since that thing was recorded against you 3 years ago, what have you done since then? Have you kept up with payments? If it's a debt management plan, have you kept up with payments since then with your debt management plan? If it's a CCJ, they might ask, has it been paid off? And it doesn't necessarily have to be paid off. For some lenders, whether you pay it off or not, they are just interested in how old that record is. As long as it's 3 years or older, they can tolerate that. But then for those specialist lenders, they can tolerate CCJs even if it's like some can lend you money even if you had CCJs 6 months ago, right? As long as it's 6 months or older, nothing else has happened, against you within that period, they're happy to lend. So if you speak to a broker or a mortgage advisor who has access to the whole of market, they can find you a mortgage lender that has a mortgage product that fits your individual circumstances, especially if you have impaired credit. It is not the end of the road. So that's the question they ask. Number one, how old is record? The other one is what type of impairment it is. Is it a CCJ? Is it a debt management plan? Is it a default? Is it a missed payment? Is it IVA? Is it bankruptcy? Okay? These different situations have different considerations by the lenders. And lenders have different ways they react to those different credit situations. If it's a debt management plan, some lenders don't entertain debt management plans, while some do. CCJs, most lenders have policies on CCJs. For some, as long as you've had a CCJ in the last 6 years, they will not entertain that. For some, if it's 6 months or 1 year ago, they will entertain that. If it's missed payments, some lenders will ask, what is the missed payment about? Is it a utility bill? Is it a secured payment like a mortgage, or is it an unsecured finance like credit card or loan, or is it a mail order? They categorize those missed payments according to exactly who it is or what the relationship between you and that creditor is. What kind of creditor is that? Some lenders, if it's a utility bill, they will ignore it. Some lenders, if it's a mobile payment, if it's a mobile phone bill that you missed a payment on, they will ignore it. But for some other lenders, whatever kind of missed payment it is, they will not ignore. As long as a missed payment is a missed payment, they will act based on that. But what happens is, for some lenders, if it's a missed payment, maybe it's a phone bill missed payment, some lenders will be able to lend you up to a certain maximum loan to value. They might reduce the amounts they will be willing to lend to you because of that. They would not say no entirely. It might affect how much they are willing to lend to you in terms of the loan to value. So if the property is, say, £100,000 property, they will say, okay, if you've got a missed payment and it's a mobile phone missed payment, we'll consider that, but we'll lend you only 80% of the value of that property. That means you have to come up with 20% deposit. Or to some lenders, they will say, we'll only lend you a maximum of 85%. So certain categories of credit impairments, the other effect it might have on your borrowing will be the amount you are able to borrow. And to some lenders, even the record of the history when they design the product, they will design it in such a way that there will be a maximum loan to value that will be available to you if your credit impairment is this old or that old. So the older it is, more likely the more you are able to borrow. If you've got 3-4 years old CCJ or default, more likely the product that will be designed for you will be different from the product that will be designed for somebody whose CCJ is just like 6 months or 12 months old. So for some, that product, the difference in that product might be the interest rate. Okay, you might be able to get a better interest rate the older the record is. Or you might be able to borrow more in terms of the loan to value the older the record is. So different lenders have different ways they differentiate these products according to, say, the product record or the kind of credit impairment it is. So these are the little things that make the difference in terms of mortgage products and in terms of the mortgages available to people with poor credit. I have seen people who have come to me and say, oh, this person's credit report was even worse than mine, but they got a mortgage. Or why have I not been able to get a mortgage? Because I have a better credit record than this person. And I always say to them, yes, I don't know the full details of this person's circumstance. And I don't know what lender has given them mortgage, because maybe I wasn't the person that did the mortgage for them. So I don't have the full details. But the details that I have and the products that are available to you is what I can offer you. So sometimes people do tend to compare apples and oranges. People's circumstances differ a lot. It might be that this person may have a worse credit record than you, but the loan amount involved, the amount that they are looking to borrow, or the amount of deposit they are putting down is higher than what you're looking to borrow, what you're looking to put down. Or the outstanding debts that they have might be insignificant enough for the lender to consider to lend to them. Maybe your own outstanding debt is more than theirs. Maybe you're looking to borrow more than they were borrowing. Because lenders also consider the risk exposures that they have before they borrow, before they lend. If you're coming to borrow, say, 90% of the value of the property, and the lender looks at and they assess you as a risk, and they look at it and say, okay, if we commit 90% of the funds to buy this property into this person is not creditworthy enough to warrant that level of risk. And then they will now decide, based on the assessment of what sort of risk you pose to them, how much they are willing to lend to you. They would then say, okay, based on our assessment of this risk profile, of this person's risk, we are going to lend to this person 75% of the value of the property. So if you can come up with 25% deposit, yes, we are good to go, we're going to lend to you. Because then it reduces their risk exposure to you as an individual. It reduces their risk exposure on that property because they see you as a higher risk. So it might be that the person you are comparing your credit situation with or the mortgage with actually put down more deposits, or they were owing far less than you were owing, or their situation was a little bit older than you. So it might be a mixture of different things. So every person's situation is peculiar, and the peculiarity of your situation is what determines how much you get to borrow and what the lender wants to do with your application. Now, the other question that the lenders do ask as well for credit impairment is, how much is involved? How much do you owe? Okay, you've got a default. What's the total amount of all the defaults that you've got? You are in debt management plan. What is the total amount of this money that you are owing? The same way they will look at, because it's a credit commitment. It is money that you are owing. And that amount that you're owing will certainly affect your affordability. Especially if there's a commitment there to pay a certain amount of that money every month. For example, somebody in debt management plan, the lender might ask, what's the total amount in this debt management plan? And they'll say, okay, it's £15,000. £15,000, okay. So how much do you pay every month to the debt management plan organization or to the organization managing that debt for you. I say, okay, I pay them £300 every month. So that £300, it's your monthly commitment. It means every single month you are going to be paying £300, even before you think of paying your mortgage. So that is a credit commitment. And then on top of that, if you have other credit commitments, like hire purchase, like credit cards, like loans, or maybe you're paying a school fees. Your children are in private school and you pay school fees. These are credit commitments that the lender will now factor in and then make a decision based on that. So how much you owe is important to some lenders in some situations, not in all situations. There are certain situations that all the lender cares about is how old is the debt. They don't care about how much the debt is. How old is, in certain situations, all they care about is how old is the debt. In some situations, the lenders will care about how much the debt is. The other question the lenders will now ask also is, what's your current status? This missed payment that you had, what's the current status? Is this status 1? Is this status 2? Is this status 3? Is this status 4? Those missed payments that you have. Some lenders, they will say, we cannot tolerate or entertain anything that is above status 2. For some lenders, they will say, we cannot tolerate anything that is above status 4. What this means is, it means how many months arrears you've been in. So even if it's historical, they want to see how many months arrears were you in at that time. If it's within the last 12 months, they will say, okay, within the last 12 months, have you had any missed payments, or have you had any arrears or any defaults? And you say, yes, I've had arrears. What's the status of that? So to some lenders, it's nothing more than status 2. If it's more than status 2, they will not entertain it. For some lenders, they are willing to take it up to status 4. But for some lenders, as long as it is old enough for them to ignore, irrespective of the status, they will ignore it and then they will lend. So these are the intricacies. So whenever you want to apply for a mortgage, if you're thinking of applying for a mortgage and you don't have a perfect credit score or a perfect credit status, pick up your credit report and take a look at that credit report and see if you can read meaning into it. Because the lender will look at that credit report and they will interpret that credit report and see whether it fits their criteria and their risk assessment. Which is why I always advise anyone who wants to apply for a mortgage, before you attempt applying for a mortgage, get your credit reports. I don't mean, like the ones you just take a snapshot of your credit score. Not the full credit report, the full breakdown. And anyone I do their mortgage, I don't touch the mortgage application until I see the credit report. Yes, I will ask you verbally what your credit situation is. You will tell me verbally what your credit situation is. But I need to see the full credit report. And then Experian, Equifax, and check my check my file. Yes, that's the one. You see, those are the three main ones I encourage people to go and check out. But then if you can sign up with Check My File has a combination of both Experian, Equifax, Call Credit, a credit union or whatever, all in one. So there are about 3 or 4 credit reports all in one if you sign up with Check My File. So what it means that you can see everything that is being registered on all those credit reference agencies, right? And because there are certain lenders that use a particular credit reference agency. So if something is registered on Equifax, it's possible that that thing is not registered on Experian, right? If something is registered on Experian, it's possible that it's not showing on Equifax. You can see that. So if a certain lender is using Equifax to do their credit checks, whatever they see on Equifax is going to affect their decision to lend or not to lend. A lender who is using Experian but not using Equifax, if that thing appears on Equifax and it doesn't appear on Experian, they will grant you mortgage, they will lend you. Because all they can see is what's on Experian, and they will base their decision on that. And some lenders do use both Experian and Equifax, right? So it's one of those things that you will not know unless you are involved in the business. And then you'll be surprised at how did this person get a mortgage and this person did not get a mortgage. There are so many things that are coming into play there. Some lenders use all the credit reference agencies, while some use just one, some use one and they don't use the other. So it depends on which credit reference agent. I have had a case where this client, we made the application for the mortgage using a particular lender, a high street lender, who was supposed, their criteria was that if that CCJ is 3 years or older, they will ignore it. So we made the application and then it was declined. So I now probed further and I said, why was this declined? They said I should check the person's credit profile. And I said, I have a copy of this person's credit profile, the Experian. I said, okay, why don't you look at Equifax? So we now went to register, I told this person to register on Check My File. The person registered on Check My File. And then we got their Check My File credit reports. And lo and behold, there has been a default that was registered on Equifax, but it was not showing on Experian. And this lender was actually using Equifax as their credit reference agency to make lending decision. So you see, that thing was showing on Equifax, it was not showing on Experian. And that thing was registered 1 year ago. And we were making this application, early this year. But 1 year ago, it was registered. And this person did not know because this person is not registered with Equifax. So it wasn't showing on the credit report that he had. But by the time we now went to get a Check My File, which had both Equifax, Experian, and Call Credit or Credit Union, everything was clear on there that there was a default that was registered 1 year ago and they didn't know. So it's very possible if you have the opportunity, if you can register with Check My File, where you can see all your credit reports on all the credit reference agencies, it pays you more. It becomes more beneficial for you. Otherwise, make sure you are aware of what's happening on all the credit reference agencies before you make the application. Because these are the little things that could affect, that lending decision. Then the lender will also ask one other vital question. Do you intend to pay this loan off before completion? You're owing this money or you've been owing this money. Do you intend to pay it off before completion? And then you say yes or no. Now, that answer may not influence the lender's decision in all situations, right? For some lenders, if you are owing, say, if you have an outstanding CCJ amount to pay, they will insist that that money or that balance be cleared before completion. And if you can commit to that, they will lend you. They will lend you the money. For some lenders, it doesn't matter to them whether you pay it off or you do not pay it off, right? All they know is that this situation is old enough for us to ignore, and we are going to ignore it. And they will ignore it and then lend you the money. So that's why it's not in every situation that it is important for you to pay off the loan. The lender will have to make their criteria clear to you or to your advisor or to your broker to say this loan needs to be paid off for you to stand a chance of getting this mortgage approved. So they will ask the question during application whether you intend to pay the loan off before completion or not. And if you say you are going to pay it off, then they will say yes. And to some lenders, if you're not going to pay it off, it still doesn't matter. So the key thing is to find out what the lender's criteria is. your mortgage advisor or your mortgage broker needs to find out from the lender what their criteria is around outstanding loans and outstanding credits. If you have a poor credit and there is an outstanding credit card that has that has been registered as a default, or there's an outstanding CCJ or an outstanding IVA or an outstanding bankruptcy amount or whatever that is outstanding, which is affecting your credit report, find out if you're required to pay that loan off. I recently submitted a case for one of my clients. They were looking to buy a property that they've lived in through a right to buy through the right to buy scheme. When the council gives you a property and you've lived in the property for a certain number of years, you become entitled to buying that property if you want to buy it. I think about 5 years. If you live there for 5 years or more, the council will say you can buy this property now if you want to buy it. So it becomes a right to buy purchase. So I recently made that application for them for right to buy purchase. The lady had defaults registered against her. And that default, yes, she explained the circumstances behind the default, and it wasn't her fault, basically. I think she was tricked into some kind of credit commitment, and some people missold her something, some kind of timeshare. And I've seen a few people that this timeshare thing have really, really messed their credits up. When timeshare was a thing, where people would just, sign up for that timeshare and thinking that, oh, this is an investment and it's going to be useful. And it turns out to be that they were missold the timeshare. So she was one of those, clients that were missold timeshare investments. And when she realized that it was a missold investment opportunity, she complained to the company, and they said, well, there's nothing we can do. You can't get this money back. You keep on paying. And she was like, I'll keep on paying all this money when I'm not getting anything in the end. And then the lenders are different from the people who even actually own, or people who initiated the investment. So the initiators of the investment will now go into an agreement with some lenders, and they will lend, and it was just messed up. So, but the long and short of the story is that she got herself into that situation, and they had a problem, and she stopped paying, and it messed her credit up. So when we were making this application, the lender that we approached wasn't interested in how much was outstanding. The lender was interested in how old was it, when was it registered. And we looked at it, and it fits the lender's criteria. The lender said, that's all we care about. If it's old enough, we're going to lend. And, we're able to secure them a mortgage, and it was a sizable amount. It was that mortgage was between herself and her husband. Her husband's credit was clean, but her credit, because of that, was a bit messed up. But it was a joint application that they had to make, and together we were able to get them, that mortgage, a sizable chunk of almost £700,000. We were able to help them borrow. So you see, you can get, that much loan if it fits the lender's criteria. You might be thinking, how can somebody with a poor credit be able to borrow nearly £700,000? Yes, we're able to get them that sorted. So it's all about the lender's criteria. If we work out your situation and it fits the lender's criteria, then we're going to make that happen for you. So that's why you need to be open enough to the mortgage advisor and let them understand your situation, and present the credit report to them. We'll read the credit report, see what we need to see, and see how we're going to present that case to the lender. So I want to thank you very much for being part of today's program again. And we're going to continue this again next week, because next week I'm going to talk to you about how you can manage your credit impairments. There are certain, tricks. There are certain things I need you to know about how you can manage your credit impairments in such a way that it will not affect your mortgage application, and you stand a better chance of getting your mortgage approved. And I'm going to see you guys again next week. God bless you. Enjoy the rest of the week. And if you can join us on Monday for our Modesty's Money Masterclass, go to our Facebook page and join the Modesty's Money Masterclass Facebook page. That is where the Modesty's Money Masterclass happens every Monday, 12 o'clock UK time. And I'm going to see you guys again, same time, same channel, next week when we continue from where we stopped. God bless you. Bye now.